If you bought a home in Australia after 2020, there's a real chance your city is heading into a mortgage crisis in 2026, and most homeowners have no idea they're exposed. In Sydney right now, entry-level buyers are spending 57.6% of their income just to service their mortgage. Adelaide has quietly crossed 51%. Brisbane isn't far behind. And here's the part nobody's prepared for. Australia's biggest banks are now warning the next move in interest rates may be up, not down, just as lending rules tighten and forced sales begin. By the end of this video, I'll show you the 10 Australian cities facing the worst mortgage stress in 2026, ranked from manageable to catastrophic, and the 3 warning signs that tell you your city is next. First, let me show you what mortgage stress actually means. According to the ABS, mortgage stress is defined as spending more than 30% of household income on housing costs. That's the line between manageable and unsustainable. But here's what most people don't realize. The 30% threshold was designed for gross income before tax. When you calculate it on after-tax income, the real percentage is even higher. Domain's Chief of Research, Dr. Nicola Powell, explained, when you backtrack to 2019, it was only entry-level homes in Sydney and Melbourne that were in mortgage stress. But now all cities except for Darwin are in mortgage stress. For units, the situation is even more dramatic. In 2019, no capital city experienced mortgage stress for units. Today, Sydney, Brisbane, and Adelaide have all crossed that threshold. According to the State of the Housing System 2025 report, 50% of median household income is needed to meet repayments for the average new mortgage. That's not a typo, 50%. Half your income gone to mortgage payments before you've paid for food, transport, childcare, or anything else. And here's the killer. Adelaide mortgage repayments now absorb 51.5% of household income, up from just 27% in 2019. That's one of the most dramatic affordability shifts of any state in Australian history. So which cities are in the deepest trouble? Let me rank them from number 10 to number 1. Before I start ranking these cities, there's something important you need to know. 2 of the cities on this list look affordable on paper, but they're actually the most dangerous if rates rise. And one city most people think is safe is sitting on the fastest rising arrears in the country. Number 10, Darwin, Northern Territory. Entry-level house mortgage repayments, below 30% threshold. Canberra entry-level house mortgage repayments, 46.7% of income. Entry-level unit repayments, 26.5% of income. Median house price, $980,000, second highest in Australia. Canberra's saving grace? The ACT has the lowest mortgage arrears rate nationally at just 0.33%. Public sector employment provides stability, but with house repayments consuming 46.7% of income, any economic shock could tip households over the edge. But these cities are the lucky ones. The next tier faces far more serious problems. Now we enter the severe stress zone, where mortgage pain becomes unbearable. Stuck 7. Hobart, Tasmania. Entry-level house mortgage repayments, above 30% threshold. Entry-level unit repayments, 29.1% of income. Economic vulnerability. Tourism-dependent economy with limited employment diversity. Hobart experienced Tasmania's property boom during COVID as tree changes fled mainland cities. Now those buyers face the reality: limited job opportunities, stagnant wages, and mortgage repayments they can barely afford. View 6. Melbourne, Victoria. Entry-level house mortgage repayments, 42.7% of income. Entry-level unit repayments, 27.5% of income. Deposit saving time, 5 years, 1 month. But here's where Melbourne's crisis gets catastrophic. According to Moody's, 5 of the 10 regions with the highest mortgage delinquency rates are in Victoria. Melbourne's west, northwest, and southeast average arrears between 2.1% and 2.5%, nearly double the 1.45% national average. These outer ring regions also record the highest unemployment in the state, between 5.1% and 5.7% in August. That's the toxic combination: high mortgage debt, high unemployment, and falling property values. Melbourne house prices are down, while other capitals boom. Investor exodus driven by Victoria's land tax changes removed 21,700 rental properties. Interstate migration has been negative for years. Moody's expects parts of Melbourne to remain a weak spot in 2026. This isn't a short-term blip, it's a structural problem. Number 5, Adelaide, South Australia. Entry-level house mortgage repayments, 45.9% of income. Entry-level unit repayments, just above 30% threshold. Median house price, $814,430, overtook Melbourne for first time in history. Adelaide's crisis is unique. In 2019, Adelaide was affordable, then prices exploded, surging faster than almost any other capital. Entry-level price growth has been extreme, according to Domain's Dr. Nicola Powell. Now, Adelaide buyers face mortgage repayments absorbing 51.5% of household income. That's higher than Sydney's 50%. And here's the killer. Adelaide wages haven't kept pace with that price growth. But we're still not at the worst cities. The top 4 face catastrophic conditions. These 3 cities are experiencing full-blown mortgage crises. Before, Brisbane, Queensland. Entry-level house mortgage repayments, 46.4% of income. Entry-level unit repayments, 34.4% of income, above the 30% threshold. Deposit saving time, 5 years, 6 months. Brisbane's problem? Entry-level prices exploded from $390,000 nationally in 2019 to $617,500 today, a 58% increase. Units jumped from $380,000 to $481,000, a 27% rise. But here's what makes Brisbane's situation worse than the statistics suggest. SQM Research forecasts Brisbane dwelling values could rise another 16% in 2026. That means mortgage stress will intensify, not ease. For first home buyers, this is a nightmare. They're already spending 46.4% of income on entry-level houses. Another 16% price rise means they'll be locked out permanently. According to Domain Analysis, households need to earn $112,667 annually just to rent a median-priced house in capital cities without exceeding the 30% threshold. Brisbane's relentless price growth is creating a generation locked out of both ownership and affordable rental. Number 3, outer Melbourne suburbs, Victoria, specific regions. Broadmeadows, north, west, northwest, southeast. Mortgage arrears, 2.1% to 2.5%, nearly double national average. Unemployment, 5.1% to 5.7%. These aren't inner-city postcodes with high-income professionals. These are working-class suburbs where household incomes are lower, job security is weaker, and property values are falling. According to S&P Global Analysis, suburbs on the fringes of bigger cities were hit the hardest by rising mortgage repayments. These are areas where prices rose recently and people bought new on small plots. Now prices are falling and higher travel costs to get to work are hitting. Moody's explicitly stated these regions will remain weak spots in 2026. This means more defaults, more forced sales, and more families losing homes. Number 2, Sydney, outer western and southern suburbs. Specific suburbs, Dolls Point, 4.33% arrears. Outer western fringe areas. Entry-level house repayments for Metro Sydney, 57.6% of income. Entry-level unit repayments, 35.8% of income. Let's be clear about what 57.6% means. A couple earning the average $120,000 combined would pay over $69,000 per year in mortgage repayments, $5,750 per month. That leaves just $4,250 per month for everything else. Food, transport, childcare, utilities, insurance, and any unexpected expenses. That means one unexpected bill, a car repair, medical cost, or job change pushes households straight into arrears. According to mortgage broker Rebecca Jarrett Dalton, intergenerational wealth is now the dividing line. If your parents own a home, you can do it too. Translation: if you don't have family backing, a deposit gift, guarantor support, or inheritance, you cannot afford Sydney. But there's one city where the mortgage bloodbath will be even worse. The number 1 city facing mortgage bloodbath is number 1, Sydney. Inner and middle ring, first home buyers entry-level house price, $990,000 or more. Mortgage repayments as percent of income, 57.6% for entry-level houses. Deposit saving time, 6 years, 9 months. Share of homes affordable to median income household, just 10%, national average 14%. Sydney represents the perfect storm of mortgage destruction. Highest property prices in Australia, $1.4 million median. Highest deposit requirements, $198,000 for 20% deposit on median home. Highest proportion of income absorbed by repayments. Longest time required to save deposit. According to PropTrack data, housing affordability in Australia reached record lows in Q4 2024, the most unaffordable housing market since records began in 1995. Only 14% of median income Australian households can afford to buy. In Sydney, just 10%. Domain's Dr. Nicola Powell stated, the extreme rate of price growth that we've seen in entry prices over the past 5 years has been led by Adelaide, Brisbane, and Perth. But Sydney started from a higher base. While those cities caught up, Sydney maintained its position as least affordable. And here's the factor that tips Sydney to number 1. No relief coming. While Melbourne's prices fall and Perth may rotate backward, Sydney is trapped in its own premium price cycle with no mechanism for correction. So what happens in 2026 when these cities face the bloodbath? Here are the 3 triggers that will turn stress into crisis. Trigger number 1, Interest rate hikes instead of cuts. CBA and NAB now forecast the RBA will raise rates as early as February 2026. NAB predicts 2 rate hikes. Core inflation remains at 3.3%, well above the 2 to 3% target. Unemployment sits at just 4.3%. If rates rise by 0.50%, a household with a $750,000 mortgage pays an extra $243 per month, $2,916 per year. For cities already spending 45 to 57% of income on repayments, that's the difference between survival and default. Trigger number 2, APRA's DTI lending cap. From February 1st, 2026, banks can only issue 20% of new loans at debt-to-income ratios of 6 times or higher. Investor lending surged 20% annualized to September 2025, now 40% of the mortgage market. First home buyers with limited equity will be shut out of refinancing. According to AMP's Dr. Shane Oliver, APRA is starting to ramp up controls to slow risky or speculative lending. The next move in rates will be up, and affordability is now worse than ever. Trigger number 3, forced sales creating market flood. Melbourne is already seeing forced sales due to mortgage stress. Listings 4% higher than last year. Outer Melbourne suburbs with 2.1 to 2.5% arrears rates approaching crisis. Sydney's outer suburbs with 4+% arrears facing a wave of defaults. According to Roy Morgan data, 27.9% of mortgage holders were at risk of mortgage stress in December 2024. That's 1.26 million low-income households in financial housing stress. When these households can no longer hold on, forced sales flood the market. More supply without matching demand means prices fall. Falling prices trap more households in negative equity. The cycle accelerates. Here's how to tell if your city is heading for bloodbath. Warning sign. Number 1, repayments exceeding 45% of income. Sydney, Brisbane, Adelaide, Canberra, Melbourne, and Hobart all exceed this threshold for entry-level houses. This isn't sustainable. 1 income loss, 1 major expense, 1 rate rise, and households default. Warning. Sign number 2, rising arrears. Rates. Victoria, 0.87% arrears rate, but outer Melbourne at 2.1 to 2.5%. Western Australia, 1.40% arrears rate, second highest nationally. Northern Territory, 1.75% arrears, highest in Australia. When arrears rise above 1.5%, that's early warning of systemic distress. Warning. Sign number 3, falling property values. Despite strong national market, Melbourne house prices falling, while Brisbane, Perth, Adelaide surge. Outer suburban areas are seeing price declines. High-rise apartment precincts experiencing capital losses. When your city's prices fall while the national market rises, that's a clear signal of fundamental weakness. If you're in one of these cities, here's what you must do. Strategy number 1, stress test your mortgage for rate rises. Calculate repayments. If rates rise 1% from current levels, if that breaks your budget, you need to either sell now before forced sales flood the market or lock in fixed rates immediately to buy time. According to State of the Housing System projections, affordability will broadly stabilize over the next 4 years, but that means no improvement, just continued pain. Strategy number 2, build emergency cash buffers. Target 6 to 12 months of mortgage repayments in accessible savings. Cut discretionary spending ruthlessly. Consider second income sources or side hustles. Moody's noted that low unemployment has helped moderate mortgage stress. But if unemployment rises, particularly in vulnerable sectors, households without buffers will default. Strategy number 3, monitor your equity position. If you're in outer Melbourne, Adelaide post-boom, or Brisbane's oversupplied apartment precincts, check your equity regularly. If you're approaching negative equity, consider selling while you can still cover the loan. According to CoreLogic, dwelling prices rose 4.9% nationally in 2024, but that average masks huge variations. Some suburbs surged 15 to 20%, others fell 10 to 20%. The median house price to income ratio hit 8.0 nationally, meaning houses cost 8 times annual household income. The share of homes affordable to median income households fell to just 14%, the lowest on record. This isn't sustainable. Something will break in 2026. In 2019, only Sydney and Melbourne had buyers in mortgage stress. Today, all capital cities except Darwin face crisis. Sydney, 57.6% of income on entry-level house repayments. Brisbane, 46.4% of income, with units above 30% threshold. Adelaide, 51.5% of income absorbed by mortgage payments, up from 27% in 2019. Melbourne, 5 regions with 2.1 to 2.5% arrears, double national average. The 3 triggers that will turn 2026 into bloodbath. Rate hikes expected in February, not cuts. APRA's DTI cap shutting out refinancing from February 1st. Forced sales flooding markets in outer Melbourne, Sydney and Adelaide. According to the State of Housing System 2025, 50% of median household income needed for average new mortgage. 10.6 years required to save for deposit, near record high. Only 14% of homes affordable to median income households, lowest ever recorded. Dr. Nicola Powell stated clearly, the extreme rate of price growth over the past 5 years has been led by Adelaide, Brisbane and Perth. Those cities saw the fastest affordability deterioration. Now they'll see the fastest mortgage stress acceleration. Sydney remains number one because it started unaffordable and stayed unaffordable. There's no relief coming, no price correction likely, no affordability improvement possible without massive income growth or price crash. I'll be tracking Australia's mortgage stress crisis every week. Arrears data, rate decisions, forced sale volumes, and which cities show early warning signs of collapse. Subscribe so you don't miss the next video where I'll reveal the exact strategies to refinance before APRA's DTI cap locks you out, and which regional areas offer escape routes from capital city Bloodbath. 57.6% of income in Sydney, 51.5% in Adelaide, 46.4% in Brisbane. Outer Melbourne arrears at 2.5%. That's not investors defaulting, that's families with kids and full-time jobs losing breathing room. Rate hikes expected February 2026. And 1.26 million households are already in financial housing stress. The question isn't whether 2026 will bring mortgage bloodbath. The question is, which city will suffer worst? And are you ready? Thanks for watching.